In this data discovery, we're going to unpack days on market. So as a research company, how do we calculate days on market? Well, put simply, it's obviously the amount of days that the property is on the market. When talking in a singular fashion, the moment that property was listed for purchase to the public, through to the moment it was sold, equals the number of days that that property was on the market. Now I'm going to get to the Suburb level days on market calculation in a moment and how we typically do that. But in this case, let's show you what the Suburb level days on market figure is calculated from, and it's obviously a sum of the parts. It's the number of days the average property takes to sell in that market. The important point that we need to make before we move on, what is the actual sale event that we look for when calculating days on market? So obviously the listing event, the moment that property is put on the market, is the easy part. That's day 0. The day that it actually sells, in this case, let's just say day 20, is the sale event, but it could be the day that the property goes under offer, or the offer is accepted, or is it when the offer is made, or is it when the property goes unconditional, or is it when the property is actually finally settled? The number that we use as a research company in calculating days on market typically, and I feel this is an industry norm, is the day that the property goes unconditional. That is now officially not on the market, it's no longer available for purchase. Up until that point, the contract could fall over, that it goes back onto the market. Now, that's generally the accepted period of days on market. What does it actually mean to be listed? Well, the property's available online, the property's posted in a window at the local real estate agent, and then obviously it is available publicly throughout the listing period to the sale when it becomes unconditional. When you're looking at an area, we don't just look at the number of days. If we were to take a point in time today to calculate days on market in a suburb, let's use Mossman in Sydney, some properties are going to be on the market, some properties are going to be selling today, and some properties might be listed today. When we calculate a days on figure number, we have to look at it over a time period. Okay, it has to be the average or the median days on markets for each property that has sold in a given time period. Okay, so I'll make this example. This is a month-long period. We have properties that have been listed prior to the period beginning, and they have sold within. We've got properties that are listed within the month period, and they are also sold within. And we've also got other properties that are listed within the month period or even before, and they are not sold yet. They are still on the market. So when calculating the days on market figure for this suburb, this property is not considered. It is still on the market at the end of that month. We only look at these two properties. Now this property might be on the market for 20 days, this one for 10. I might put another example in here, another property that's been on the market for 30 days. When calculating the suburb average, we add all those together. 3 properties have sold in that period. They may have been listed for sale in the period as well, but they may have been listed for sale prior, just reiterating that point. When we're calculating the average days on market for that period, it is now 30 plus 20 plus 10 equals 60. Divided by 3 equals 20. That's the average days on market figure for the month, the rolling month in retrospect. The median, obviously, in this case, is the middle number, which is 20 as well. Sometimes, a median figure for days on market is less volatile. It cuts out the edge cases. We use it more typically because it does reveal the more current and accurate market dynamic. When you go into averages, it might be thrown out by very long-term properties that have been sitting there for some time. Okay, so we generally use that median figure to assess the current rolling days on market number. Now, the important point, let me delete this. The important point to consider is not the actual days on market figure for the area. It is the trend line of that number. Is the days on market figure tightening or expanding? This is a demonstration, I might delete this, of the market dynamic. All right, so a balanced market, we've got buyers over here and we've got sellers. This is a balanced market where you would assume the days on market figure as a signal of the market demand, the market heat, as stable also. But as a market transitions where the sellers have the momentum, or there's more sellers, than buyers, it's actually a buyer's market. The buyers have control, and you would expect days on market to be increasing. Lots of sellers, lots of properties coming into the market. The buyers can be very fussy. There's less of them. Okay, they have more to choose from. The properties are sitting around on the market at the same time. So in a buyer's market, days on market, you would expect to be going up, right? Contrast that with buyers and sellers, more buyers versus sellers, okay? This is a seller's market. This is the market that we're operating in 2021. In this example, we have a very tight market, limited supply and lots of buying demand. In this example, you would expect days on market to be decreasing. When we are trying to identify areas to invest, we don't necessarily look at the days on market number. It does generally need to be under 90 days to demonstrate a healthy market nationally, but it's the trend line, it's the velocity of change of that days on market that signals to us a change in buying dynamic, and that's where the opportunity does comprise. And I'll show you that as an example of how do we assess that change, that rate of change. Because if we're looking at a month-long period here, we've got a 30-day moving average for days on market. If we were to then contrast that to a 90-day period, we've now got one short and one long-term moving average. It's one days on market figure could be trending down and the other one could be trending upwards. It's the cross in those moving averages, a short term moving to a long term or a long term moving to a short term. It's the cross in those moving averages that signifies a change in direction. It signifies to us as an investor that there is a change going on the ground here to the buying and the selling dynamic, and that creates opportunity. It might be an opportunity to leave the market because the heat is dissipating, or it might be an opportunity to start considering the market because we have a tightening of the days on market figure. So days on market, it seems simple on the surface, but we need to unpack it to understand how it impacts us as investors, how it creates opportunity and how it helps us to identify those areas to stay away from.